This topic is called capital structure decisions, and what we shall be discussing in the topic is we shall discuss the meaning of capital structure, we shall look at the notations, we shall look at the schools of thought, we shall look at the assumptions of capital structure, and then we shall look at the arbitrage process. Capital structure simply means the ratio of debt to equity in the composition of the funding of a firm, because firms can raise money through any source. They can raise money by borrowing, they can raise money through sale of ownership right, which is sale of equity. So therefore, capital structure is the proportion or ratio of debt to equity. And this topic, capital structure, is very important to us because debt is a form of risk. So therefore, the proportion of debt that is in the capital structure of any company is of importance to us because the higher the proportion, the higher the risk that the company will be facing. The higher the proportion, the higher the risk that the company will be facing. So we want to be sure that the company is carrying appropriate risk. We shall then look at the assumptions of capital structure decisions. The first assumption of capital structure decision is that there are only two sources of funds available for the firm. There are only two sources through which the firm can raise funds. These two sources are debt or equity. It is either the company borrows or the company sells shares, sells the right to ownership in form of shares. The second assumption is that the companies don't pay tax. The second assumption is that companies don't pay tax. The third assumption is that all profits that the companies make are paid out as dividend to the owners of the firm. All profits that the company made are paid out as dividend to the firm. So therefore, there is no profit that is retained. The fourth assumption is that there is no growth rate. The fourth assumption is that there is no growth rate, which means that the companies don't grow revenue, that they make the same profit every year, that their profit do not grow. If they make a profit of 1 million this year, their profit next year will also be 1 million. Year in, year out, they are making the same amount of profit. Let us now look at the notations that we shall be using in this topic. The first, we shall represent debt. Shall be represented by capital letter D, while equity shall be represented by capital letter E, and then the overall value, the overall worth, the overall value will be represented by V. V will then be the addition of debt plus equity, while KE will represent the cost of equity, KD will represent the cost of debt, while KO will represent the weighted average cost of capital. We are weighting the average because we have two sources. We are weighting the average because we have two sources of funds, which is debt and equity. Let us now consider the schools of thought. Actually, there are 4 schools of thoughts that are involved there. The first one is the traditional school of thought. The traditional school of thought brought up the argument that the value of the firm is determined or is influenced or is affected by the capital structure. The traditional school of thought came up with the argument that the value of the firm is influenced by the capital structure, but they did not tell us which direction the value will be influenced, whether it will be influenced positively or negatively. But they just believed that the value of the firm will be influenced by the capital structure. The second school of thought is the net income school of thought. The net income school of thought came up with the argument that indeed the value of the firm, that's the overall value of the firm, will be influenced or will be affected by the capital structure, and it will be affected in such a way that the more debt that is introduced into the firm, the more the value of the firm will rise, and then the overall cost of capital will reduce. they came up with the argument that debt causes the overall value of the firm to rise. That as you increase debt, the overall value of the firm will rise, while the overall weighted cost of capital will decline. The third school of thought, which is the net operating income school of thought, hold the argument that to get the overall value of the firm, all you need to do is to capitalize the profit by the overall cost of capital, and therefore it doesn't matter whether you increase debt or you don't increase debt, the value of the firm will remain the same. And then the final school of thought, which is also the Miller and Modigliani school of thought, argue that even if the value of the firm increases by increasing debt, that the process called arbitrage will come into play, that people will take advantage of that increase in value of the firm as a result of the increase in debt, and then we cash out. Let's go ahead and look at this school of thought and their demonstration. This is the net income school. The net income school again holds that the value of the firm will rise as the value of debt rise. That the more debt you introduce into the capital structure of the company, the more the value of the company will rise. Let us now take example that XYZ PLC is a company that has a 14% debt of 800,000 and has made a profit before interest and tax of 300,000 with a cost of equity of 16%. They argue that if this XYZ PLC decides to increase debt, if the XYZ decides to increase debt from 800,000 to, let's say, 1 million, that the value of this firm will also increase. First of all, we shall approach this by determining what is going to be the value of the firm when the firm had 800,000 debt. The first approach to determine to understand what the net income school is saying is that we determine the interest to be paid on that loan. That interest is 14% of 800,000, and that is 112,000. That's going to be the interest. If the interest is 112,000, and then the company XYZ Limited, XYZ PLC has made profit before interest and tax of 300,000. They have made profit, so interest will be paid. Interest less interest of 112,000. Then profit before tax then becomes 188,000. But remember, take note that one of our assumptions was that companies don't pay tax. One of our assumptions was that companies don't pay tax. And another assumption was that all profit made will be paid out to the shareholders. All profit, there will be no retention of any part of the profit. So therefore, for us to get the value of equity, since the cost of equity is calculated as dividend paid into 1 plus growth rate all over current market price plus G. But another assumption told us that there will be no growth, that the companies will not grow. So if we strike this out, it means that our cost of equity will be dividend paid all over current market price. And then this current market price is the same thing as the equity. So to get our equity will then be the dividend paid all over the cost of equity. This dividend paid is the same thing as the profit before tax. Since our assumption is the same thing as the profit before tax, since one of our assumption is that, okay, let me use equal to. Since one of our assumptions is that companies don't pay tax, and one of our assumptions is that all monies made as profit must be paid out to the shareholders. So therefore, the value of equity then becomes 188,000 divided by 0.16. So if we divide 188,000 by 0.16, we will get the value of equity to be 1,175,000. Now that we have known the value of equity to be 1,175,000, we can then determine the overall value. We can then determine the overall value of the company. The overall value of the company would then be debt plus equity. In our example, debt was 800,000, while equity is 1,175,000. So therefore, the overall value of the firm becomes 1,975,000. And then the weighted average cost of the company is calculated as the profit before interest and tax divided by the overall value of the firm. So therefore, the weighted average would then be 300,000 divided by 1,975,000. If we do this division, what we will have is 15.19% as the overall cost of capital. What we will have is 15.19% as the overall cost of capital. Now that we have known the overall value of the firm when the firm was utilizing 800,000 debt, we realized that the overall value of the firm is 1,975,000, while the weighted average of the firm is 15.19. But remember that the argument of the net income school is that if you increase debt, that the overall value of the firm will increase. So therefore, what they are trying to say is that if the company decides to increase this debt to say 1 million, that this overall value of the firm will go up, will increase, while the overall cost of capital will decrease. So let us look at this demonstration again. Let us demonstrate what they are trying to say with the example. Now the debt is now 1 million, while the interest rate still remains 14%, and then the profit before interest and tax remains 300,000. Because one of the assumptions is that the profit don't go, it remains the same thing year in, year out, and then the cost of equity remains 16%. What will happen is that the company will, first of all, before the company will pay the shareholders, we distribute the profit to shareholders, they will first of all pay interest. And so the interest to be paid will be 14% of 1 million. That will be 140,000. That will be the interest to be paid. It will be 140,000. So therefore, the company has profit before interest and tax of 300,000. And then if they pay interest of 140 out of their profit, it means that they have 160,000 left as profit before tax. And remember that again, that one of the assumptions is that companies don't pay tax. Rather than pay tax, they distribute everything to the shareholders. So therefore, the value of equity will then be the profit before tax divided by the cost of equity, which gives us 160,000 divided by 0.16. If we then go ahead to divide 160,000 by 0.16, what we have is 1 million. It means that the value of equity will be 1 million. If the value of equity is 1 million, we can then determine the overall value of the firm, like we did when the debt was 800,000. The overall value of the firm again remains debt plus equity. That's debt here is 1 million plus equity that we just calculated of 1 million as well. So therefore, the overall value of the firm becomes 2 million. You will notice that in the first example, when debt was 800,000, what we had as the overall value of the firm was 1,975,000. Now that the debt was increased, you can see that the value of the firm has increased from this to 200,000, and then the overall cost of capital becomes profit before interest and tax divided by overall value of the firm. That's 300,000 divided by 2 million, which gives us 15%. Unlike the other time, the overall cost of equity was 15.19%. So you can see the argument of the net income school that if you increase debt, the more you increase, as you increase debt, the value of the firm will continue to rise, while the overall cost of capital will continue to fall. Now to the net operating income school. They argue that the way to determine the value of the firm, is to divide the profit before interest and tax by the overall cost of capital, and not the way that the net income school went about it. So in the example, if we have a 14% debt of 800,000 with profit before interest and tax of 300,000 and overall cost of capital of 20%. What they argue is that the way to get the overall value of the firm is to divide the profit before interest and tax by the overall cost of capital. When you have now gotten the overall value of the firm, you can then deduct debt from the overall cost of the firm to get your equity. You can then deduct debt from the overall cost of firm to get your equity. And that if debt is increased, what will happen is that the cost of equity will increase, because the shareholders will continue to view the firm as becoming too risky. So therefore, they will increase their internal rate, they will increase their cost, the cost of equity. So let's look at this example, so that the value of the firm here becomes 300,000 divided by 0.2, that's 1.5 million will be the overall value of the firm. So therefore, if we deduct debt, if we less debt of 800,000, it means that the value of equity will be 700,000. The value of equity will be 700,000 if we deduct debt. So having determined the value of equity, we can then determine the cost of equity, which is again d into 1 plus g, dividend into 1 plus g divided by equity plus g. But we assume that there is no growth. So therefore cost of equity will then be dividend paid all over equity. In this case, the dividend paid we have to calculate the dividend paid. In this case, we will have to calculate the dividend paid. First of all, interest will be paid of 14% of 800,000, that's 112, and then profit before interest and tax is 300,000. If you less interest of 112, you have 188,000. That will be the value of equity. That will be the value, the profit, or maybe profit before tax, or profit available to shareholders. So therefore, the cost of equity here then becomes 188,000 divided by 700,000. That gives us, I think, about 27% cost of equity. That gives us about 27% cost of equity. Now again, the argument of the net operating income school is that it doesn't matter if you increase debt, that the value of the firm will remain the same thing. But that if you increase debt, what will happen is that the overall value of equity will continue to reduce, and then this will force the shareholders or the equity holders to raise the cost of equity. So let us consider in this instance, if the company decides to increase debt from 800,000 to 900,000, still making the same profit before interest and tax of 300,000 with a weighted average cost of capital of 20%. What they argue is that the value of the firm will remain the same thing as profit before interest and tax divided by overall cost of capital, which is 300,000 divided by 0.2. It remains 1,500,000. So therefore, the increment in debt from 800,000 to 900,000 did not affect the value of the firm. The value of the firm remains the same thing. So if we deduct the value of debt now of 900,000, we will get the value of equity to be 600,000. So you see that unlike in the previous demonstration, the value of equity was 700,000 because the value of debt was 800,000 in the previous demonstration. So now that the company has decided to increase debt from 800 to 900,000, the value of equity has dropped from 600,000 from 700,000 to 600,000. So let us now see what will happen to the value, to the cost of equity, because as the value of equity has dropped, the shareholders, the equity holders, will then raise their cost of equity. So to determine the cost of equity, we first find the interest, which is 14% of 900,000. That is 126,000. So if we deduct profit before interest and tax is 300. If we less interest of 126,000, what we have is 174,000 as profit before tax, or profit available to shareholders. So if 174,000 is profit available to shareholders, it means that the cost of equity then becomes profit available to shareholders divided by the value of equity, and that's 174,000 divided by 600,000, and that should give us about 29%. So if you consider in the first example, when debt was 800,000, the cost of equity was 27,000, and now that they have increased debt, the value of the firm has remained unchanged, but the value of equity has dropped. So therefore, the cost of equity has risen to 29%.